Hey guys, welcome to another Trade Genius podcast. Bob and Phil here as always. I know this market's been going up, but guess what? Not for long. Why? Well, we got a lot of data to go over, but what you're going to see in this video is quite troubling. You're not going to want to miss this, so let's dive in.
Trade Genius.
Hey guys, really briefly before we jump into this video, appreciate all the likes and subscribes, and if you can ring that notification button, that really helps us out. In addition to that, if you guys don't mind, head over to tradegenius.co, check out our specials we have over there. There's a number of different specials with different packages for all different experience types. If you're more into education, we have a package for that. If you just like to get into the room, primarily, we have a package for that as well, where you can see where we're calling out trades and things like that live, and also posting signals into our Discord signal rooms. So check it out, tradegenius.co. Appreciate you doing that. Bob, you've been sleuthing, and the data you uncovered is quite concerning. Can you tell us about it?
Yeah, I mean, look, I think we're whistling past the graveyard here. What's interesting is from a stock market perspective, we've been unable to break back into the upper quadrant, basically to take back what I would call the phase one of the bear move. And we just keep banging our heads at this level. But at the same time, the narrative is coming at us is that everything is bullish and is starting to be reflected in the sentiment numbers. If you want to throw that chart up first, Phil. I mean, look at this thing. We've gone from 30% to 51%. Guys, this is a contraindicator. Okay, this is what's called dumb money. Now, you ever heard the phrase dumb money, smart money? It doesn't mean you're dumb or smart. It means you're informed or ill-informed. And the ill-informed are throwing the chips in. There's a lot of desperate people that should know better, that are pushing hard on the trades. That's why you see it in the breath readings. They're just chasing the biggest names. I mean, Apple goes up $5 in one day. I mean, the move was bigger than the GDP of Ethiopia in one day. It's just insane. And it started pulling right back again. But look at the bottom of that particular chart. The allocation is 100% equities. I mean, who does that stuff, Phil? That is so stupid.
Yeah.
Amazing. At the same time, you're starting to see, this is really cool. We didn't really know where to slide this slide in, but it's really interesting. This is how the Bloomberg research views the potential for recession. And they're looking at, the United Kingdom, New Zealand, United States, Canada. You notice here, it's the Five Eyes countries, the Anglo countries that are slipping into recession at the highest rate. And I thought that was really interesting to see because I want to try to understand it from, perspective of, another source. The one thing that did make me laugh though, if the United States goes into recession, there's no way China does not.
Right.
So some of the stuff's a little bit ridiculous, but a lot of this is also determined by basically the liquidity. And I'll get to that slide in a second, that's been pouring out of the Anglo environment. And before we get to that slide though, Phil, this is a slide that you've always talked about, but it's really cool to see it in a different form and also a deeper look back than we've ever seen before. This goes back to 1871, Phil, okay? This is what you always talk about when they pause, we have 100 weeks kind of a thing.
Right.
And this is just another way of looking at, we're 15 months away from what I would call an aggregate bottom in stock market returns based on what happens with the funding levels and credit constraints and credit availability, M2, the whole shebang here. And we're really sitting on really the edge here. And they noticed they're the first Fed cut. Our view here at Trade Genius is that we think July ends it. I think we got a little bit more backing from that from some of the statements that we've been seeing here in the last 2 or 3 weeks from Fed governors and also from other people saying that they're still trying to push on this thing to basically flip the unemployment rate and the inflation rate around. But I think personally, we'll get a rate cut before the end of the year. I think it's going to become intolerable for Powell to hold rates at, a potential 6% terminal rate. I think you'd see an absolute implosion in the economy. There's going to be a lot of oppression. Maybe the implosion is what drives it. Then we're going to take this big old dump here for about 12 to 15 months, which ties right into what we've been telling people. Right, Phil? I think you were saying end of 24?
At the earliest, yeah. And probably more like second quarter of 2025, actually.
Yeah, this could be a pretty interesting presidential run.
Yep.
So I think it supports the outsiders versus the insiders on that. And here's the other thing too. The banking thing. The banks just did their reports, and you want to pull your hair out and say, "Oh, banks are doing great." Well, they obviously lowered expectations, but we have a problem here. The large banks are well fed and the small banks are starving. I read somewhere, but I couldn't quantify it, but I'll just share it with you that the thinking is in 3 to 4 weeks, the small banks get capital reserve constrained again. They're just going to cause probably another round of failures or takeovers or, draconian actions by the federal government. And the scary thing about this, Phil, is that if we go into it with the Treasury on empty, how are they going to liquefy these banks or pay FDIC out? It's going to be a nightmare. Right. And it's coming. They said 3 to 4 weeks out. I'll try to find out more information on what that really means. And if I can quantify it, we'll put it in a chart. As you guys know, we don't like this to talk narrative here. We like to back it up with data and information from, multiple sources. So I thought that was really interesting. That kind of got me a little nervous, but that ties right into what we've been seeing on this 40-day cycle, Phil. Right. I mean, up and we're down February, up March, down whatever, how it's been going. Yep. But check this out. This ties right into it again. This is the, I think it is the M2, the money growth, money supply.
Money supply.
Look at this. Look at the United States. We're diving like a submarine, and there's been no turning up from that move. And I think it's just going to be, and this thing's lagging too. It's not like, tomorrow we'll let you get loans again. I mean, this is going to start having psychological effects on people, Phil.
Right. Yeah, that's pretty stark. And it drives, people, I've seen sentiment where it's like, oh, well, the global liquidity is going up, but it doesn't matter. Like everyone forgets how huge the US dollar market is, and it drives everything. It doesn't matter if China's inflating their currency. It really doesn't. It's whatever the US is doing, it's ultimately going to drive the entire global market.
Yeah, and this next chart kind of reflects that. Just look at how we just been very consistent on driving this thing down. And like you said before, China's going to pull us out of this. China has a lot of issues. They're trying to reignite their economy, but their economy is so imbalanced, Phil. They're requiring exports, and then internally, because they lock their people's money in, people speculate in non-productive assets like housing. They just speculate.
Right.
And if all of a sudden the export markets to the United States gets cut off, I don't care what China does. They're not going to give money to the people to buy refrigerators. That's just not who they are. So it's going to be a big problem.
Right.
And now I think we're going to flip to the employment side. So Phil talked about this yesterday about the Fed's not going to pause until they get a crossover. Well, I think that crossover is coming in spades. This is the Challenger Gray report showing that look how fast layoffs are coming up the pike. And if you notice those peaks, those are all recessions.
Yeah.
Okay. So this is a big problem. And once this gets started, everybody kind of follows along, just like when Elon Musk realized that I didn't need 80% of my staff to run Twitter. And then you started getting that reverb throughout the tech industry. Well, once bellwethers i.e. like Microsoft starts laying people off, and Microsoft is, but McDonald's, and you got Apple, trying to trim back, they got 40% shipments down. All of a sudden, everybody plays follow the leader here. Everybody's a sheep. Mm-hmm. And I think that thing's going to really spike, Phil.
I agree. And this next chart, I think, is foretelling.
Yeah, and here it is. Job openings are collapsing. And we've heard anecdotally from people, in our room, that have friends looking for jobs. There are just no jobs. At least no jobs at the wages in which people have been accustomed.
Right.
And, losing your job in a rising price environment is extremely painful, especially since that you may have to move, and not just move down the street. You may literally have to move out of high cost areas just to survive.
Right.
And it's going to become brutal. So I wanted just to throw that at you, Phil. Like when I had machine gun style here, I'm going to take a break and get your thoughts on this.
Yeah. This chart here, if you guys are looking at it, they inverted the job openings so that it matched how the unemployment rate flows. But otherwise, it's when the job openings decline on the chart, it's flipped upside down, but job openings declining leads the unemployment rate, and we're getting a decline in job openings right now. And this is by design. The Fed wants this, right? So the market is not really reflective of what's coming. But if you look at previous bear markets, 2008 was the worst one we've had in recent memory. And that had very typical rallies like we're seeing now. And everybody just gets lulled to sleep. But if you zoomed out on 2008, even though those rallies were sharp, some of them 20 to 30%, they failed to make any higher highs. It was all lower highs. And even with this run up, we're still at a lower high. So, and then if you look at how the market's been rotating, we go up into OPEX, options expiration, which is when all of the big bets for the month, those option bets expire. That happens this Friday. So what I'm thinking, I know you're on the same page, is that we'll probably have some sort of drift up into Friday or this week in general, but somewhere in this week, maybe early next week, is where we have to be very careful about looking for weakness in the market, because we have the potential now from this point to unravel this entire thing. And if you look at what's lining up, the Fed's gone back to tightening after that bump in the bank bail-ins or bailouts, however you want to look at that, from last month. Yellen's on fumes. Yellen's been supporting this market by draining the Treasury account, and that's gone. It's effectively gone. She's at some of the lowest levels that we've ever seen historically. So her effects on the market are very small. That leaves the banks, and the banks are increasingly parking their money in the safety zone of money markets and things like that. They're speculating less and less in this market. So the momentum here is stalling. You see the bullish momentum, especially from the retail sector, going back to the peaks. People, you can see the sentiment online. If you didn't know better, we were in the middle of 2021 again, except that the fundamentals are vastly different. Back then the Fed was throwing more money at this market than we've ever seen in our lifetimes. And today they're actually actively pulling money out. So complete polar opposites as far as what fuels this market is going on here. And like I said before, this is actually a gift. This is an opportunity to get out here before things really start to roll over. We peaked out at, I can't remember, 4,600, 4,800, somewhere in there. And we're only down at, effectively 4,200 as of Friday, or just under that a little bit. I mean, that's really good considering that this economy is stalling and rolling over. So take the opportunity here to hedge up, shore up, and protect yourself, because the second half of the year, especially when the debt ceiling raise happens, and it will happen, Yellen is going to be doing things as far as issuing debt that are going to have a negative, more than we're seeing now, and a negative effect on the markets. And that's where things, I think, are all going to come together and converge. You're going to have bad job data, bad this, bad that. Fed's going to be out still on the mission to tighten. Yellen's not contributing to the market. Banks are going to see that. They're going to be parking money in the safety zone of the money market area. And you're just not going to have a lot of things driving this market into the second half of the year. Something will break, and then we'll reset the cycle, and the Fed's going to come back in and save the day. And then everything that you ever wanted to see go up starts going back up.
Yeah, I agree. And I mean, even the volatility guys we're talking is that the Fed needs to change the mindset of the investor. Mm-hmm. And he's determined, what was the word? Reduce the wealth effect of stock investors, which is pretty scary. Mm-hmm. So why be the victim? Just be water, and just slide on over and hedge yourself, get into treasuries, get into cash. There's a couple really good short hedges that are easy to manage without leverage. And, if you want to learn how to trade those things, you can always check us out. But yeah, and look, guys, this is not an easy one to fix, because I think a lot of things are happening in the world that just don't say, the United States is just going to V this thing right back up. I think this is going to be more like an L. And, you have geopolitics. The Republicans are loath to give Biden any kind of runway for success going into the election, for sure. And the BRICS nations, for many, many reasons from their standpoint, they want the United States to be down a peg. And then you just have demographics that are not favorable. And you just, you have a skill mismatch. You have a mismatch in desire. You have a mismatch where the jobs are going to be and where the people live. And so it's going to be I think a pretty brutal transition, Phil. And, and it could even go past 2025. I mean, I was reading up on some of these kind of transitions before. A lot of these recessions or depressions, whatever you want to call it, can go up to 4 years long. And that's what I'm saying. Don't screw around with this stuff, guys. Don't be speculating. Be really, really, really careful.
Yeah, because retail doesn't really get the memo until you're back down. Like, this market rolls over. If you take from the lows to the highs, let's say we go down 50%, like we retrace, not 50%, but we retrace half of this move up. By then, retail starts going like, oh, wait. Yeah, maybe we are going down. And then it's like, okay, well, I'll wait for a bounce, and then the bounce doesn't come. But this is market psychology 101, and the banks count on that, and they play against you on that. So just be mindful that in these environments, they want you to be the exit liquidity. They're counting on retail to be there, to be the sucker, to hold the bag, while they're engineering liquidity to get out. And that's exactly what's going on here. And if you look at the market volume, it's very thin. There's not a lot of participation. So they're trying to draw in, and this is what typically happens in bear market tops. They try to draw in the liquidity. You call that the late bull bulls or the late buyers, and they're the ones that end up coming in. And like you saw in that sentiment graph earlier, we're at like 50%, whereas we were at 22% bullish the other week or the other month. It's gone up quickly, and that's exactly what happens in bear markets. So there will be a time to get long this market. It's just not right here. There's just too many factors that are coming to a head now that are going to give us a big headwinds into the second half of the year.
Yep, totally agree.
All right, guys, well, let us know your thoughts down below. Appreciate the views and the likes. Please smash that notification bell. That really helps a lot if you could set it to all. And we'll see you on the next video. Take care. Bye-bye.
Trade Genius.